When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds. However you get your news.
This is Bloomberg Daybreak Middle East.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua at the World Economic Forum here in Davos, Switzerland. Now, JP Morgan held its first investor day in more than 2 years yesterday. The chief executive, Jamie Dimon, was on the defensive over the lender's expenses, strategy, and shareholder communication. But he was bullish on the U.S. economy. Well, here to discuss more is Bloomberg's Charlie Wells. So, Charlie, Jamie Dimon also speaking to Bloomberg TV just 15 days ago. What were the other takeaways from the gathering?
Yes, Francine, so very interesting. You know, JP Morgan has been on defensive over the past 5 months or so. Its share price has really taken a beating in the markets, and that really has been over the issue of expenses. So on a fairly routine conference call in January, unexpected expenses were disclosed, and analysts have been wondering about those for the past few months and asking for more clarity. Well, they got that yesterday with Jamie Dimon explaining that the bank is going to maintain a very disciplined expense strategy, explaining some of its acquisitions, and also announcing the hiring of 1,300 wealth managers as it seeks to boost its business in that area.
So we saw JP Morgan's share price rise yesterday by the most since November 2020. Was that news of the bank's expense discipline and investments?
Yeah, so there was a lot at stake here, right? You know, the bank really needed to communicate that expense transparency. But, of course, Dimon did make those positive comments that you mentioned about the state of the U.S. economy a little bit more bullish than I think many people may have expected. You're getting a little poetic there, saying that, you know, the threats facing the U.S. economy are a little bit like storm clouds. And the thing about storm clouds is that they can dissipate. And that seemed to have a positive impact, not just on JP Morgan's share price, but also on bank shares across the board. So JP Morgan, you know, the top 5 performer in the S&P 500 yesterday, Citigroup right behind it, the 6th performer, and Bank of America, number 8. So, you know, positive news across the board for the banking sector.
So Charlie, they basically convinced investors.
You know, Francine, you know better than pretty much anyone in this business that Jamie Dimon is an excellent communicator. He is good at simplifying a story and making it clear to the audience. And that really seems to be what he did yesterday. He talked about the ABCs of businesses that don't do well. He talked about good expenses versus bad expenses. And of course, he did use that slightly zen statement about storm clouds.
Yeah, the poet that is Jamie Dimon. Charlie, thank you so much. Charlie Wells there on the very latest from JP Morgan. Now, Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kay Lyons in New York, Anna Edwards is in London. We'll have plenty more from Davos 2022. This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
We are not in a panic mode. We had to digest three major shocks, right? The pandemic shock, the war shock, and the energy transition shock.
Our democracy is at risk. And our system, economic system, is at risk.
I don't think a recession is inevitable.
The dollar, we think, is vulnerable on a cyclical basis and also a structural basis.
There's been carnage in public growth stocks.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Tuesday, May 24th. Our top stories today. Snap's shockwave. The parent of Snapchat plunges after slashing its forecast. It's dragging other media stocks down too. China rolls out a new stimulus plan, including tax relief, but UBS and JP Morgan cut their growth forecast for the Chinese economy. And ECB President Christine Lagarde tells Bloomberg recession is not the central bank's baseline forecast for the euro area. We are live in Davos with more from that Bloomberg exclusive conversation. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, plenty of news flow coming through from Davos. The vibe in the markets, though, seems to be overly affected, really, by what we heard from Snapchat Snap and their comments that really have affected any company that's exposed to advertising revenue.
Yeah, you're seeing tech really dragging markets down all across the world, Anna. It's true in the U.S., it's true in Europe, and it was true in Asia overnight, where the Hang Seng Tech Index was the big underperformer. It fell about 4 percentage points in the Asian trade. Now, of course, part of that has to do with the drag around sentiment because of Snap, but of course you also have more broadly the overhang on Chinese and Hong Kong markets of COVID zero policy. You actually had Hong Kong's chief executive Carrie Lam out overnight saying it is very unlikely that those border controls put in place to contain COVID-19 are going to be relaxed during her term. Remember, that term ends at the end of June. And of course, in China, they also are trying to grapple with COVID zero policy on the one hand and potentially offset it with fiscal and monetary stimulus on the other. But investors don't seem convinced by the measures China has rolled out so far. That is reflected in a 2.3% decline for Chinese equities overnight. A Chinese yuan that is the big underperformer in Asian FX, weaker against the dollar by about 1/3 of 1%, right around 668. And of course, iron ore, a commodity sensitive to the Chinese growth story. You saw those futures down about 3.7% in Singapore overnight, Matt.
All right, so some really big moves in Asian markets, and we're looking at some pretty bleak markets here in terms of risk sentiment. S&P futures down 1.5%. Of course, if you're short these markets, then I guess it's reason to celebrate. But investors are buying bonds, stocking up on the perceived security of government debt in order to guard against drops in equities. We're also seeing NYMEX crude move to the downside just a little bit, just under 110 a barrel for Texas Intermediate. You still see, I think, about 113 right now for Brent crude, the global benchmark. And Bitcoin coming down, but only about 0.5%. So still at 29,176, holding around that general 30,000 level when investors seem to want to buy it, but they're not doing that today because it's so well correlated to risk assets. Anna, what are you seeing in Europe?
Yeah, not buying European stocks either then, Matt. We see European stocks under pressure today, and some of that is to do with the Snap news that we got overnight. Also concern and caution around the growth story out of China, of course. So this is what we have right now for European stocks, in particular the French market down by 1.5%. Let's get to the FX markets, though, because here we see some action as well based on some commentary, some interviews we've been doing here at Bloomberg TV, but also based on some data that has dropped into these markets over the last half hour or so. Firstly, the euro pushing back up against the US dollar. Christine Lagarde speaking to our colleagues in Davos, speaking to Francine Lacqua and saying that a recession is not their baseline case for the Eurozone. And so we see a little bit of an upward move on the euro there. The pound moving in the other direction quite decidedly, down by 0.8% against the US dollar. The services data out of the UK disappointing by 5 points. It's still above 50 on that PMI reading, so still in expansion territory, but dropping pretty fast and coming in much lower than expected. That has investors or market participants dialing back expectations for just how many rate hikes we will see from the Bank of England. Publicis, I picked that one. I could have put WPP, I could have put in a broadcaster, ITV. All of these businesses have one thing in common. They're being influenced by what we heard from Snap yesterday. Anything that is exposed to advertising, being shaken by those comments coming through from that particular business in the tech space over in the United States. And this is Scottish and Southern Energy, down by more than 10%. The FT carrying a report that says that the Treasury might be looking at not just oil and gas companies for some sort of windfall tax, but also looking at power generation businesses. And so we see this and Drax and Centrica and others in that space all falling on that report today, Kaylee.
All right, Anna, so already a lot going on this morning, including at Davos, and we'll be getting more interviews from Davos throughout the day. But that is not all that is ahead on this Tuesday. We'll also hear from Fed Chairman Jerome Powell, who'll be speaking in a pre-recorded video at 12 p.m. New York time. Then we'll get more retail earnings with Abercrombie & Fitch, Ralph Lauren, and Nordstrom all reporting. Plus, on the politics front, voting will take place across 5 U.S. states today, including Alabama, Arkansas, Georgia, Minnesota, and Texas. So we'll keep an eye on those primaries. And finally, on the economic data front, we'll get U.S. PMI data at 9:45 a.m. New York time, Matt.
All right, we'll be watching for that, for sure, PMIs in America, considering what we saw, the disappointment in European PMIs. Let's talk about the disappointment, though, in tech. Social media stocks taking a hit as Snap cuts its revenue and profit forecast below the low end of its own previous guidance. We get more from Bloomberg's Laura Wright in London. Laura?
Brutal in pre-market trading. Matt Miller, Snap down almost 30%. Other social media names taking a hit, mirroring what we saw in after-hours trading. In the last earnings presentation, Snap forecast revenue growth year over year of between 20 and 25%, along with adjusted EBITDA between break-even and $50 million US. Then yesterday, in a memo to employees, Snap's founder and CEO Evan Spiegel stated that due to these deteriorating macroeconomic conditions, revenue and profitability are likely to be below the low end of that guided range. The challenges that Snapchat are facing, however, are not unique. Inflation, interest rate hikes, the war in Ukraine, those Apple privacy changes, and these myriad of headwinds mean that companies reliant on advertising revenues, such as social media platforms, are now vulnerable. Nasdaq 100 futures trading down around 2% this morning. The outlook pretty brutal for the tech sector. For the first time in 15 years, U.S. value is now outperforming U.S. growth. And I have a chart for our radio listeners that shows that only 12% of stocks on the Nasdaq 100 are trading above their 200-day moving average. Investors, they want to see returns and have limited appetite for expensive tech names like Snapchat, which currently trades at 51 times forward earnings.
Yeah, valuations have come in quite a bit, but a lot of these stocks are still quite expensive, relatively speaking. Thank you so much to Bloomberg's Laura Wright. Now, turning to Europe, ECB President Christine Lagarde rejected the idea that the euro area is heading for a recession. She spoke to Bloomberg's Francine Lacqua exclusively earlier at the World Economic Forum in Davos.
We don't have that as a baseline. You must have heard that sentence a million times, which is why we also do scenarios. And we have the negative, the adverse, the various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
Joining us now from Davos is Bloomberg's Francine Lacqua. Francine, great interview. How does what you heard from Madame Lagarde track with what her colleagues on the ECB are saying, as well as what you're hearing from the other great business and economic minds at Davos?
Well, Kelly, it was really interesting because this was the first time under the presidency of Christine Lagarde that we had a president writing a blog and saying, this is where we are now in the economy. This is what interest rates will do. This is when we'll hike. And this is where we're expecting to be in a couple of quarters. So it was a real, very detailed roadmap of what's coming ahead. Now, the critics will say this is a way for her to front run her own hawks. So the people that want her to be more aggressive on interest rates because she's laid it out to the markets. Others will say, well, this means that there's some kind of consensus within the Governing Council of the European EC Central Bank. So the question now is there a trade-off between inflation and growth? We also spoke to the French governor, and of course he said absolutely not, because the ECB has one mandate and they have to stick to that. And then the other question, if they're no longer negative rates in September, does it mean that we could see positive rate? I know it's nuances and it's really in the detail, but this changes everything for the banks here in Davos.
Yeah, and the euro, meanwhile, fights back then, clawing back some of that lost ground in previous weeks against the US dollar. Francine, thank you very much. Bloomberg's Francine Lacqua over there in Davos. We'll be back with Francine and back to Davos shortly. Back to the news flow overnight, though. China has rolled out a broad package of measures to support businesses and stimulate demand. That's as it seeks to offset the damage from COVID lockdowns on the world's second largest economy. Bloomberg's Tom McKenzie has the latest for us. And Tom, we see the Chinese coming forward with a package of not just 31, 32, but 33 measures to try to support the Chinese economy, but some big banks taking down their growth forecasts.
Yeah, absolutely. In terms of the measures, finally, we have some detail fleshing out the rhetoric that we've heard from policymakers out of Beijing in the last few weeks. A 33-point plan, in fact, from the State Council, including tax cuts worth around $21 billion US, support for the airlines, obviously very badly hit, support for the railways, infrastructure spending around railways, and also tax cuts for autos. So if you purchase a car now, you get a bit of a tax cut on the back of that. But economists within China, some very vocal ones, are saying, look, you need more support for households, more support for individuals, including cash handouts. That has not yet come. And of course, a lot of this is down to the fact that the restrictions remain in place in cities like Shanghai and elsewhere in China. Bear in mind, you can cut taxes on autos, but not a single car was sold in Shanghai in the month of April. Wow. Tying into what you've said, this is why you've got the likes of JP Morgan and UBS downgrading their forecasts for growth for China, UBS cutting to 3% on the back of that lack of clarity. You can have all these measures, but until there's clarity and that lack of uncertainty in terms of what is happening in COVID-0, the pressure will remain on this economy.
Not a single car sold in Shanghai in the whole month. How many people live in Shanghai?
You've got around 25 to 30 million people living in Shanghai. Around 25 million, I think.
Unbelievable. Tom, thanks so much for that. Bloomberg's Tom McKenzie rounding up the China situation for us. Let's talk, though, about the Biden administration. Trade representative for the U.S. says the U.S. has to be strategic when it comes to dealing with tariffs on Chinese goods, the possibility of lifting those tariffs. This comes after President Biden said he would consider removing some of the Trump-era laws. Catherine Tai spoke with Bloomberg yesterday.
With respect to the tariffs, our approach, as with everything in this relationship, is to be strategic. We have to keep our eye on the ball in terms of how to effectively realign the U.S.-China trade and economic relationship.
Meanwhile, of course, President Biden stoked tensions with China with a vow to defend Taiwan militarily. The White House walked back those remarks a bit, saying the president was only promising Ukraine-like military weapons aid. Dan Tenkate, Bloomberg Asia government managing editor, joins us now in Hong Kong for more. You know, Dan, the idea that we would send weapons is already a little bit controversial, but did it seem like the president was suggesting we would actually interact militarily if China were to attack Taiwan?
Yeah, I mean, that was kind of the stunning thing about the exchange. It was with a reporter who basically said clearly, you know, you've stayed out of Ukraine militarily. Will you go into Taiwan militarily if China attacks? And Biden said, yes, you know, we made a commitment. So, you know, that's what spurred all the headlines around the globe saying that. And, it would represent a big shift in American policy. You know, there's always this debate about, strategic ambiguity versus strategic clarity. And the U.S. policy for years has been, we won't tell you exactly if we're going to go in or not. So it looked like a policy change at the moment. The White House quickly walked it back. And now everyone's just trying to figure out, was he doing it deliberately? Was it a gaffe? What's going on here?
Yeah, no doubt there will continue to be comments around this, Dan. Let me also take you to what we've heard from the so-called Quad meetings. So President Biden making his first trip to Asia and keen, of course, to meet with other members of what are known as the Quad, a four-nation security grouping, the US, Japan, India, and Australia. What have we heard from those meetings?
Yeah, well, you had a big symbolic showing, the new Japanese Prime Minister Modi, of course, in India, the new Australian Prime Minister just elected over the weekend. Out of that, we had the most substantive thing was probably, an agreement to shine a spotlight on all the Chinese fishing movements around the South China Sea, basically have a big radar going from the Indian Ocean to the South China Sea and beyond. So, the point is that now they're trying to put really concrete measures on this relatively new grouping, that is trying to counter China and show democracies in the region, another path, another alternative to dealing with Beijing.
Yeah, India's relationship with the others in that grouping, one to watch for sure. Thanks very much, Dan. Bloomberg's Dan Tenkate joining us there from Hong Kong with the latest on the geopolitics. Coming up, we'll get back to the markets. Jimmy Conway, head of EMEA equity trading strategy at Citigroup Global Markets, joins us. How concerned is he about companies that have advertising revenue at this point? We'll head back to Davos and we'll hear from Dr. Seth Berkley, CEO of Gavi, the Vaccine Alliance. Just how have they been coping with the COVID-19 pandemic? What is still left to do there? Plus, more from our exclusive interview with the ECB President, Christine Lagarde. We'll bring that to you later in the programme. This is Bloomberg.
Everyone you meet in Port Harcourt has stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Earnings season continues.
There's so much nervousness in the market right now.
This market punches you in the face.
Bloomberg is fastest with the numbers and analysis.
Big numbers from Disney.
It just slammed expectations.
Bloomberg, the fastest numbers and analysis you trust.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. We want to get back, though, to Switzerland. In Davos, Bloomberg's Francine Lacroix is sitting down with Dr. Seth Berkley, CEO of Gavi, the Vaccine Alliance. Francine?
Yeah, thanks so much, Matt. Doctor, thank you for joining us. I have 1,000,001 questions on vaccines and COVID and where we are now. Now, you've said that every country at the moment can actually meet their demand for the vaccines or has enough supply to vaccinate the population. The problem is demand. Where are you seeing the most issues with people not wanting to get a booster or not wanting to get vaccinated, full stop?
So, I mean, we've really changed. So one of the exciting things that's happened, I mean, COVAX has delivered 1.5 billion doses to 145 countries. Coverage rates, 46% in low and lower middle income countries. Global average around 60%. So still inequities. Yep. We have to work on that. But that hides the fact that there are still low coverage countries. So there were in January 34 countries with less than 10% coverage. Today that's 18, but 14 of those 18 are fragile countries. And so what that requires is really hard work on trying to help deliver in those settings, working to build sustainable and resilient delivery systems. And that's where the challenge is right now. But as you say, we do have enough vaccines now to make those available for primary doses as well as boosters if countries want them.
I mean, did you ever think we'd be in a situation, so almost June 2022, where you have half of Europe, the US, which is acting as if there was no COVID right now because we're over it, and China, which is still almost in full lockdown?
I think it's really a challenge right now. Complacency is so strong. Many countries have gone from lockdowns to opening football stadiums with people cheering, you know, in packed stadiums without masks. And that is a problem. Now, of course, if you're in a country that has very high vaccine coverage, we still have to worry. People do still get sick and die. But in general, the vaccines protect pretty well against severe disease and death. So they have more ability to do this. But that's not necessarily true in countries that have low coverage. And that's why covering the healthcare workers, the elderly, and those with comorbidities is absolutely critical.
How close are we to this next generation vaccine that actually stops infection, full stop, stops transmission?
I mean, you know, there's a lot of research going on. There's now a couple of dozen vaccines that have been approved, but there's 180 odd vaccines that are in development, many of which are looking at mucosal immunity. That's, you know, getting it in the mouth and nose to protect there. Different types of vaccines, trying to diversify and get a broader immune response. But right now, there isn't one right available here. And so the ones we have continue to work well. But of course, we don't know that that's going to be true for the next variant or the variant after that. And that's what we have to continue to be prepared for.
But how close do you think? I mean, could we be a year away, actually, from this non-transmission vaccine? And does it change if that people want to get vaccinated with that? Because they think, well, if I don't catch it at all, then this is, you know, I'll go and get vaccinated for that.
Of course, we'd like to have a vaccine that blocks transmission of disease, like a measles vaccine. Very effective at doing both of those. The challenge right now is we don't have any, and it's hard to predict exactly when because we have to wait for the data to see, you know, what happens here. But I have no doubt, I have faith in science, and I have no doubt that science will solve it. The challenge then will be getting it out to the rest of the world. But you know, we've made 12 billion doses. You know, who would have thought that was possible? You know, many times more than what the globe uses of vaccines. And so industry has really stepped up.
Should we worry about monkeypox?
Well, I mean, the thing about monkeypox is if this was in one of the endemic countries, the answer is you do worry about it because it's an infectious disease. It can't spread. What's strange here is the fact that it's now in, more than a dozen countries and hundreds of cases, and we don't yet have a link between them. And until that link is worked out, I think we have to watch it with caution. We do have vaccines and we have drugs that work on that agent, and it's not highly transmissible. It's not highly transmissible. That's right. It's in the family. It's not smallpox. It's in that family of viruses, and you can use a modified vaccinia Ankara, which is a type of vaccine against smallpox that will provide protection for that, and there are some antivirals as well. So, I mean, the thing here is it's not transmissible in the same way, and so I don't think we're not talking about another COVID pandemic.
I mean, COVID, this is an important question. If you look at COVID and the fact, the relationship that it's changed between us and actually our health, does it make us more likely to see the next pandemic because we worry, even monkeypox and things like that? Or do people write it off and saying, oh, this is, once again, the people of this world trying to worry us about what's coming up next?
I mean, this is the challenge. We have had a series of panics, neglect, panics, neglect, panics, neglect. I mean, in Davos here and after the 2015 Ebola outbreak, it was #1 on the risk registry of what people were concerned about. The next year it was gone. And that's really the challenge. What we need to do is move to a place where in peacetime, when there isn't a pandemic, to continue to invest, to build the systems, to make sure we're prepared for the next one, because I think we've now seen $12 trillion worth of damage from this little virus. And so I think what the message has to be is let's figure out how to make the world more prepared. And that is a topic here.
Steph Barkley, thank you so much for joining us here in Davos for day 2. That was, of course, Kaylee, the chief executive of Gavi.
All right, Bloomberg's Francine Lacqua joining us with that interview with Dr. Seth Berkley. Thank you so much from Davos. Now, keeping you up to date with news from elsewhere around the world, here's the first word. Kansas City Fed President Esther George expects the central bank to raise interest rates by 2% by August. To 2% by August, I should say. After that, she says more tightening will be guided by how fast inflation cools off. George has been known as a longtime policy hawk who more recently moved to the center. In China, the top official for pandemic control has shifted her attention from Shanghai to Beijing. That's raising pressure on the capital to contain a lengthy outbreak. And it may signal that harsher restrictions are on the way. Chinese Health Czar Sun Qianlan urged authorities in Beijing to implement more measures tied to the COVID-0 approach. Broadcom could announce an agreement to acquire cloud computing company VMware as soon as this week. VMware shares rose 25% on Monday after Bloomberg reported that the talks were underway. The company currently has a market valuation of more than $50 billion. The Broadcom offer is likely to be mostly in the form of stock, but would include a large cash element. And Zoom is signaling it can expand beyond its consumer-friendly video software that helped the company to a pandemic boom. The company projected revenue would increase about 10% in the current quarter. That's better than estimates, but still its slowest quarterly sales growth ever. Zoom is now focusing more on business customers. And of course, Matt, this is really just emblematic of the stay-at-home trades that were so popular during the pandemic unwinding in a massive way. I just checked out Zoom share price since its peak in October of 2020. This stock is now down 84%, and it's not alone in facing that kind of pain.
Yeah, still shocking declines there. On the other hand, I feel like Zoom is doing a little bit better than, say, a Snap because they don't rely on the advertising, right? That's why they're switching towards business clients. And Anna, of course, we spend a lot of time on Zoom every day.
Yeah, and I feel it's become a verb. Whenever you become a verb, you're into some sort of different territory, aren't you? But it was interesting to see them navigate the move to hybrid working, because if that's the reality that many of us in financial services, at least, are going to be facing, then that is something that, Zoom still plays a role in. And there was some commentary on that coming through from the company, which was interesting to note, and actually pushed their share price up in the immediate aftermath of the results. But you're right, Katie, did fall back afterwards. When we come back, we'll talk about what we've heard from tech and media stocks. Jimmy Conway, head of EMEA equity trading strategy at Citigroup Global Markets, joins us. What did he make of the vibe coming through from Snap? Also, banks in focus this morning after Jamie Dimon speaks out. We'll talk about that next. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently. because various studies showing that reduction up to 40-fold, meaning that a third dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus Omicron variant still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Snap's shockwave, the parent of Snapchat, plunges after slashing its forecast. It's dragging other media stocks down too. Facebook owner Meta Platforms and Google parent Alphabet are among the losers. China rolls out a new stimulus plan, including tax relief. It's mostly aimed at businesses struggling with COVID lockdowns. But UBS and JP Morgan cut their growth forecasts for the Chinese economy. And ECB President Christine Lagarde tells Bloomberg recession is not the central bank's baseline forecast for the euro area. We will bring you more of Lagarde's comments from that Bloomberg exclusive interview in Davos. Welcome back, everybody. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. And Matt, European equity markets taking a pretty gloomy look at things this morning.
Yeah, it's pretty gloomy here as well, but not nearly as bad as the end of last week. I can't believe I missed that. I'm glad to be back in the markets, although S&P futures are down 1.4% right now. Investors are buying bonds in order to maybe hedge against those risk drops a little bit. NYMEX crude coming down 0.5% to 109.73, and there's a risk-off indicator here in Bitcoin as well, but not much of a move really. This is the price change from midnight, 29,251. It's really all about Snap, right? And over the last 10 years, I've never figured out Snap. I still don't really understand it. And even more today, Kaylee, like, isn't it just about the kids, not listening to their parents, snapping at the dinner table? Like, why would there be an advertising slowdown for the kids? They're never going to stop.
Well, if you ask Snapchat, Matt, the issue is geopolitics, inflation, supply chain, all of these things that mean companies are shifting around their advertising budgets. I guess if you're facing higher input costs, you're having a little bit more difficulty passing those on to the end consumer. Maybe you're going to cut back on some of those advertisements. But is this kind of a situation like we see with retail sometimes when they blame the weather? And this is just a company that is facing slowing growth, and it's easy to blame the macroeconomic environment. That's something we can dig into later on this hour when we talk about this a bit more. But nonetheless, Snap shares are receiving a brutal punishment in pre-market trading this morning, down a whopping 28% and taking some of those social media peers down with them. The likes of Meta Platforms, which is the parent company of Facebook, down 7%. Pinterest is down more than 13%. One of the more positive stories out there, though, is Zoom. It reported earnings after the bell yesterday. Its second quarter revenue forecast topped expectations. That sent the stock up as much as 21% in the after-hours trade. In the early hours trade this morning, the gain is not that large, up just about 6.5%. So maybe investors still questioning the long-term trajectory of this stock in particular, because as I said earlier, Anna, still down 84% from its peak in 2020.
Yeah, impressive of sorts. Kaylee, let's have a look at what we've got here on European equity markets then. And this negativity that we're seeing in US futures, the Matt was just going through, that's definitely reflected here in Europe. And some of the stories that Kaylee was referencing there around Snap having an impact here. So Stocks Europe 600 down by just over 1%. The pound is really in retreat today, down by 0.75% against the US dollar. 124.94 is where we trade on cable. And this has to do with some of the really negative data we got on services. That services PMI number disappointing by 5 points, and it was still above 50, so still in expansion territory, but much lower than had been anticipated. Just how quickly is the UK economy slowing down with the cost of living crisis front and centre, and how many rate hikes does it mean there will be room for from the Bank of England? And the market seems to be reassessing that as we go through this morning. Gilt markets reflecting that too. Here's the read across into Snap. WPP advertising giant down by 3.9%. It seemed there was enough in that Snap release to just raise a few questions about whether businesses are going to continue to spend on advertising. We know when geopolitics is tough, that can be tough too. Scottish and Southern Energy down by 9%, and this reflects falls across the sector. There are other companies in this power generating sector, not just in the UK, but actually into other parts of Europe that have also been hit by these reports, suggesting we could see windfall taxes on this kind of business, as well as the consideration as to whether to windfall tax oil and gas players, Matt.
That, I think, a fascinating story, and you got to wonder how much that incentivizes those kind of businesses to invest the next time you really need them. Let's get to a bank's, though, or a bank CEO's view on the market, specifically UBS's Ralph Hamers. He expects more clarity in global markets within the next 3 months and says he is optimistic about the direction of rates in Europe. He spoke to us in the World Economic Forum in Davos.
Rates getting into positive territory is a good thing, in my view. We can make bigger steps there. Real rates are still negative. Therefore, I do think that from a policy perspective, it may not be as bad to make those moves. And it builds you a buffer for ammunition when you need it again.
Jimmy Conway joins us, head of EMEA equity trading strategy at Citigroup Global Markets. And I guess, you know, the main question, Jimmy, which you must get over the last few days and weeks is, have we fallen far enough yet? Have we priced in the increases we're expecting from central banks, the effects of the inflation that we've seen, and the expectation for slowing down growth?
I think it depends on which one of those you want to pick apart. I think, you know, in terms of the derating of the market, we've clearly done it, you know, chopped a huge amount of wood. I think in terms of the tightening, we're getting to that point whereby we're sort of seeing an inflection point. So, for example, the correlation between the equity market and the bond market is breaking down. That was a huge problem for Q1. I think what is a little bit more problematic is the extent of the unwind. You've got a decade's worth of inflows into US equities, which I think is now a little bit under pressure. We see evidence of that in things like, you know, the realized volatility of the NASDAQ versus, for example, the bank sector in Europe. And so I think we're at that stage now where the unwind and credit risk are what could take us a little bit further. So those are the things that we are paying most attention to.
So in that kind of environment, Jimmy, I'm wondering if it's a dips are safe to buy or you want to sell the rips. Our market producer, Pete, pointing out to me this morning after the last 10 1% plus gains on the S&P 500, 9 out of 10 times the next day the index is lower on average by about 1.4%. And lo and behold, after yesterday's gains, S&P futures are down about 1.4%. When will sell the rips stop being the play?
I think when you see the inflection point from the Fed, you know, we've lived for the last decade in an environment where we've always talked about the Fed put, and that's largely because inflation hasn't really troubled the waters. Now, I think the inverse is true. Every time we get up to, you know, 4,200 in the S&P, for example, it seems that we're confronted with hawkish Fed speak, and so that free put has almost become. Free put for those who want to be long and buy the dip has become a free call almost for those who want to stay short the market. So I think you have to wait until you've seen, firstly, the clearing price for credit risk, and secondly, the Fed inflection point. And those two are obviously quite hard to time.
Is the Fed put now exclusively for credit, not for the equity market, Jimmy?
No, I don't think so. I mean, I think that's the big problem, right? Is it there for credit at all as well, right? The Fed is, as many other central banks are, is making it very explicit that their mandate and their priority is to get inflation under control. And it depends what are the sort of victims of that process. I think credit is a more important feature for the Fed. I don't think they want to get to the point whereby we have a credit crisis, but that's a very, very difficult thing to control in time, especially with secondary market liquidity not being great.
Jimmy, good morning. Are you still looking for inflation hedges at this point, or are you looking at strategies that protect in a downturn? Clearly, central banks are still very focused on the inflation fight, but what should the strategy look like? Should it focus on inflation fighting or on growth slowdown?
I think you're still going to see support for commodity inflation. I think that's still an interesting pocket. And in Europe in particular, there's a real problem because it's an underweight, right? We've had lots and years of ESG expansion and various reasons why it's been difficult to commit capital to that sector. And indeed, the sector hasn't done any of its own capex. Strategically, beyond that, inflation hedges, yes, there's sectors like the banks, which I think are just fundamentally very cheap in an inflationary environment. But really what we're looking at is balance sheet.
Okay. When I look at the European stock universe, though, to your point, energy stocks up by 22% year to date, where, a lot of other sectors, obviously retail, consumer products, all of these falling drastically. So energy really does stand out. I don't, there's a lot of politics around whether that we might see kind of windfall taxes being applied to those businesses in power generation businesses. Clearly, we don't know where that politics will take us, but I guess that's still a risk. That's an increasing risk, perhaps.
Yeah, look, I mean, it's done very well year to date, but look at it relative to the broader market. It's still below where we were pre-pandemic. And then look at where crude is. And then I think throw into the equation that these companies, many of which have sort of been told by the market for years that you have no terminal value. You're dinosaurs, you're on your way out. So what do? Well, you get yourself incredibly lean, right? The operational gearing. I mean, look at the free cash flow that these guys have. And I think that's very, very difficult to overlook, especially in a world where the expediency of needing more carbon-type products is perhaps leading investors back to being able to commit capital to them again. So, yep, I think there are short-term pitfalls like the ones you've mentioned, but on a sort of 2 to 3 year outlook, it's very hard not to see this underweight being addressed more.
And, I mean, when you hear about these windfall taxes, and we've seen something similar here in the U.S. where the government is going to just attack these guys when they're down and then, tax them when they're up. It's got to make you shy away from investing. It's got to make them shy away from investing.
Yeah, I think that's right. I think, I'm no sort of political expert by any means, but if you think about the rational economic decision that you would make as one of these corporates, you have to be, I mean, these are not, it's not like a software program, right? It takes a while for these projects to come to fruition. You're looking at 2, 3, 4, 5 year plus type projects. So I think trying to guarantee that the return on investment is in excess of your cost of equity, which is, I guess, the equation as to do I do this or do I buy my shares back? That's still very problematic without certain assurances. And I would imagine that, headlines along the lines of what we've seen this morning make that calculus even more problematic, shall we say.
Jimmy, thanks very much. Thanks for joining us. Jimmy Conway of Citigroup Global Markets, giving us his thoughts on the equity market picture at this point. Coming up, we'll be back to the tech names. Snap shocks the markets. The social media company is down in pre-market trading and dragging others with it. More next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, let's get back to Snap, which cut its forecast below the bottom end of its guidance that morning, adding to woes for the sector, which already is reeling amid stalling user growth. And Snap shares are down nearly 30% in pre-market trading at this point. Joining us now for more is Matthew Bloxham of Bloomberg Intelligence. So, Matt, is this kind of the thing where it's really easy to blame supply chain issues and inflation for the reason why you're coming up short, and this is just a company that has seen the peak of its growth already? Or can we really blame those macroeconomic headwinds?
I think it's a mixture of the two, to be honest. I mean, I think there's a lot going on in the digital ad space right now with, the kind of move to first-party data that's kind of making it harder for those digital campaigns to run as effective as they did before. But, clearly we are in the face of a big economic slowdown, inflationary pressures on advertisers that'll be squeezing their budgets, and advertising is one of the first things to go if, CPG companies are looking to protect their margins. So I think it's a mixture of things going on here.
We're seeing, Matt, good morning. We're seeing some quite big moves and some quite big European companies on this front, aren't we? WPP, Publicis, both down today in the advertising space. ITV, the broadcaster, down. It almost as if the market was primed to look for this kind of negativity. We know that things in an inflation environment, as you say, might get tough for those exposed to advertising.
Yeah, that's right. I mean, we called out on the ITV results recently that we thought consensus for ad revenue was a bit optimistic this year. We were surprised that the ad agencies upped their revenue guidance for this year on the back of a strong Q1, because it seemed obvious that things were going to get tougher. So it's not surprising to see those shares come under a bit of pressure. But I think that the signs are already there that these guys are going to face tougher, definitely second half of this year on the revenue side.
Matt, we heard from Snapchat that the supply chain is causing a problem in their advertising numbers. I guess I can make the connection, but can you help me through that? How does the supply chain of physical goods end up affecting advertising revenue?
Well, I mean, my interpretation with them is that essentially that they are very much a direct response platform, that they're looking to help brands drive sales. And if those brands don't have goods to sell and the supply's dried up, then there's less reason to actually spend dollars in trying to sell something you can't put in the hands of customers. So that's my interpretation of it. I mean, ironically, you'd think as ad budgets come under pressure through this year, actually most of the remaining budget will go towards sales activation. But yeah, if you've kind of got this kind of combination of weakening demand and constrained supply, then it puts brands in a difficult place about where to put their ad dollars.
And finally, Matt, there's obviously a lot of conversation about a potential recession coming in the next, say, 18 months. Is this something we can expect only will get worse for these social media companies as time goes on and as policy gets tighter?
Yeah, I think so. I think clearly a lot of CPG companies in particular that are big advertisers are looking again at their budgets. Their margins are under pressure. As I said earlier, the ad spend is something they'll look at as one of the first things to go. So I think as the kind of squeeze on spending mounts for consumers, I think you're potentially looking at more pressure on budgets overall and for that whole kind of advertising value chain.
Matt, thanks very much. Matthew Bloxham of Bloomberg Intelligence. Thanks for bringing us the details there. Coming up on the programme, a turning point for monetary policy. More from our exclusive interview with the ECB President, Christine Lagarde. She spoke to the team in Davos. This is Bloomberg.
When you think space, you probably think One space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Lots happening on Wall Street.
It's the basic law of economics.
It validated what the market was already pricing.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
It's a challenging dynamic.
We could continue to see that kind of strength.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio. However you get your news.
This is Bloomberg Daybreak Middle East.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kayleigh Lyons in New York. Now, Christine Lagarde is not in panic mode, she says. We spoke to the ECB president exclusively from the World Economic Forum in Davos. And my colleague Francine Lacqua asked about the path ahead.
We are at a turning point. We have all the components in place for that. We are turning our back to negative interest rates. We are moving very likely into positive territory at the end of the third quarter. And then, of course, we will calibrate. We will establish exactly by how much we want to do that.
When you talk about, of course, no longer negative rates, has the market quite understood that this could mean also positive rates?
Well, you know, when you're out of negative, you can be at zero, you can be slightly above zero. This is something that we will determine on the basis of our projections, on the basis of our forward guidance. I think that there are good reasons to believe that all three conditions will be satisfied in June and further on during the summer.
Where are we in the third quarter? Could we be, you know, above zero in terms of interest rates? Is that kind of the trajectory?
This is what I'm saying I stick to.
Yeah.
We will be out of negative interest rates, most likely before the end of the third quarter.
How do you see inflation developing from now? I mean, again, there's so many unknowns because of the war.
You know, there are lots of forces, and some of them, you know, counteracting against each other. You have the war, which in and of itself is an absolute drama and has massive economic impacts, not just in Ukraine and eventually in Russia, but for the rest of the world. We have energy prices, which have gone up significantly and represents a big chunk of inflation. We have food prices. I mean, there's a whole series of things that are weighing on growth down and pushing inflation up.
How likely is it that the Eurozone goes into recession?
We don't have that as a baseline. You must have heard that sentence a million times, which is why we also do scenarios. And we have the negative, the adverse, the you know, various alternatives there on the basis of hypotheticals such as boycott of oil, interruption of gas supply that clearly would have a significant impact on the economy. But for the moment, we are not seeing a recession in the euro area.
All right, an exclusive interview with the ECB president, Christine Lagarde in Davos, who doesn't see a recession, I should say, as her base case, which is comforting. Bloomberg's markets correspondent Kriti Gupta joins us now on set with her chart of the day, and I'm excited.
I'm excited.
We don't usually get chart of the day this early.
But you get a single best chart from Tom Keene, so we're doing something similar here. I want to marry the two big stories of the morning. These comments from Christine Lagarde with the Snapchat earnings that we saw after the bell last night. But I want to macro it and look at the Solactive Social Media Index. Essentially, this is an index that includes the likes of Facebook, now Meta, Twitter, Snapchat, and also the other social media names from around the world. And what I'm really trying to get at here is to look at it from an ad spend kind of point of view, given that ad spend can be a proxy for global growth. And what you're seeing basically for our radio audience is a 10-year chart where you do see some kind of, I don't want to call it a boom and bust type cycle, but certainly a boom cycle where you see these massive gains. It kind of stalls out as the economy stalls out, and it goes over and over again.
But it comes back. So these are social media companies that shot up during the pandemic because we were all locked down and locked in to Facebook and Snapchat and Twitter, etc. And the idea is now that we can leave the house again, we don't need to be stuck to our devices.
Well, that's part of it. The other part of it is simply the fear that's baked into the market, and this is the macro part of it, because remember, a lot of this is based on ad spend. You're not going to spend money on marketing, on advertising, if you don't think the consumer is actively going to spend those dollars. And right now, that seems to be the fear that's not just in Snapchat earnings, but across the board, even outside of social media.
Yeah, it's a great point, and I love Matthew Bloxham's point, which is that especially if these people don't have anything, if these companies don't have anything to sell because of supply chain problems, why would they buy ads?
Yeah.
All right, Kriti Gupta with the chart of the day. Thank you very much for that. Let's get to what else we're watching, and I'm focused really on retail earnings today. Remember the retail disaster that led to last week's well, mini crash, I think, is a fair way to put it in terms of risk assets. Now we have a ton more retailers on the higher end, or at least what I perceive to be the higher end. So you've got Ralph Lauren coming out, Anna, with earnings. You've got Nordstrom coming out with earnings, and companies like Best Buy, and I think most importantly, Petco. Now, the reason is Dan Curtis, who was one of our producers in London, said, look, if people are taking fewer food selfies, I think we have a full screen of this quote, if people are taking fewer food selfies, the world is a better place. If people are spending less on their pets, well, we're all in trouble. And it's a great point because you don't need SNAP, right? I still haven't figured out what it is, but you do need to buy food for Fido, and if you're not doing that, then times are tough.
You do, but is this, going back to the SNAP story, I mean, is this just the, IRL fighting back? And if in the real world that we've all gone back out into, maybe we don't need quite so many pets? Controversial, but some people got a lot of pets during lockdown.
We have the pets.
Yeah, I know, you've got to feed those ones that you've already got, but maybe you don't need another one. I'm just saying. I'm focused on UK eco, and this actually taps into what we've been talking about with Snap and confidence in the future, because we just saw this composite PMI number for the UK, 51.8. That dropped from 58.2 the last time around. That is a big drop, Matt. That is also a big miss because the estimate was 56 or so. How is this reflective of, consumer sentiment weakening in the UK? The gilt market's already adjusting to lower expectations for hikes from the Bank of England. So this, looking at confidence in the future, is something that we're going to be doing a lot. That is it for the early edition. Surveillance in Davos is ahead. This is Bloomberg.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
We're in this new normal where inflation is much higher than anyone expected.
This inflation is going to be pretty persistent, not where it is now, but way above where the Fed wants it to be.
The market has raced ahead of the Fed, anticipating the Fed to be very aggressive in their actions.
The Fed's not going to back away because the market's tough. The Fed's going to back away because inflation starts to slow later in the year.
Raising interest rates is not going to solve the problem of inflation.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene from Davos. It is day 2 of these unusual meetings of the World Economic Forum. John is on assignment. Lisa and I are here in a very changed Davos. I think the shock of summer, the shock of May, rather, instead of January, and other ideas. Some of us, I am the, you know how there's like a token driver. I'm the token rested tonight. I went to bed and had the early surveillance. You were up partying all night last night. What is the Davos mood?
The Davos mood right now is a lot more quiescent, to use your word, than it has been in prior years. I hear this is my first year here, but everyone keeps talking about both the weather being warmer, but more importantly, that fewer people are here. There's also a more serious tone, not only because of the backdrop of Ukraine and what's going on with the humanitarian disaster, but also markets. You know, yesterday we saw a bit of a pop. Today we're giving it up. Today people are concerned once again what they're not seeing around corners with respect to China's slowdown and the bleed out into a rapidly deteriorating view.
But the way we are in this bear market is, let's be blunt, James Dimon salvaged the market yesterday. I think that's true.
Well,
and we need somebody else to come out and get growthy on us today.
The fact that one company or one CEO can move the market to such a degree, today people are going to blame Snap and what happened there. Shares down about a third of the entire value. The social media company, because they came out with a letter basically saying that the backdrop is deteriorating faster than expected. The fact that things are moving so quickly on one name at a time shows the lack of certainty out there that's driving a lot of jitters.
Yeah, I'm going to call it 2 calmer days in the market after the shock, and of course the bond loss backdrop is front and center. But to me, the word that we're going to talk about this in a moment with Gita Gopinath of the International Monetary Fund. Lisa, to me, the recession watch is still part of the conversation. I'll be honest, I find the recession watch sort of foolish.
Well, why?
Because I think that people have a media description off NBER of 2 negative quarters, and we're all doing the math. And a recession is more than that. It's more complex.
Foolish or not, all of the public officials have had to speak to that. Christine Lagarde this morning coming out and saying it is not inevitable. Others coming out and saying that unfortunately it is, including Citigroup CEO Jane Fraser. Right. And so these are some of the crosswinds underpinning a lot of these discussions.
It is. Can we say there's a toxic brew in the sky today? Yesterday was a windstorm.
Yeah, what do you have today to solve for the windstorm?
It's a fog. Yeah, what we want to do is to show, and this is what saved us yesterday. Schwarzkopf got to be glued, blasting freeze spray, and we thank the Schwarzkopf people for their support.
Can we just be clear? It didn't save us yesterday because our hair was flying all over the place. But today it will be saved. Yeah, exactly. Let's take a look at the markets.
Please,
what's going on? You are seeing right now,
that
actually the Nasdaq is giving up and then some. The gains from yesterday, at least in early trading, you can see it down almost 2% earlier today. It's retraced some of those losses. The S&P down 1.3%, 39.22. The euro continuing to make gains against the dollar, 107. And the reason why that's interesting, again, Christine Lagarde saying she's not going to accelerate this, and really drawing a nuance between supply side and demand side inflation, saying this is supply side driven and that demand doesn't have to be what they address. 10-year yields back down, yields down, bonds up, and you're seeing that 2.8%. Not a huge move there, just dipping just a bit. And today, honestly, we have amazing guests.
We have amazing guests. I think it's been 2 days in a row of really lovely intelligence. And to me, the one looking forward here, and particularly for Global Wall Street, is Bob Prince.
Yeah, we're going to be speaking with Bob Prince of Bridgewater right now. We're going to be speaking with Geeta Gopinath in a minute. I will stop talking so that she can talk. First Deputy Managing Director at the IMF.
Let's never stop this.
Tony Capuano, also Chief Executive Officer of Marriott International, along with Bob Prince, among them luminaries that we're going to be having, Tom.
This is very important and a wonderful day for us to start here in Davos with Geeta Gopinath. She's First Deputy Managing Director at the International Monetary Fund, but far more than that, through the pandemic, has linked economics into this once-in-a-lifetime event. We're thrilled that she could join us. In full disclosure, you'll be with me on a panel tomorrow on growth, which is hugely anticipated here because of your attendance. I loved what you said to the Indian media, I believe it was a day ago, I can't remember, where you just really pushed back against the recession gloom. How do you respond to market pundits who maybe once read an NBER paper and say, a recession's coming? How do you respond to that?
I say hi, Tom and Lisa. On global recession, yes, I mean, we're getting that question a lot. Our April numbers for global growth was 3.6%. Now, at that level, that is a healthy number for the global economy. There are headwinds, absolutely. There are many downside risks. But I think to say that at this point, globally, for the global economy, that there is a recession, I think that's a bit premature. But that said, I think there are regions of the world that are getting hit quite hard, especially with the war more recently, and Europe is such a region where you could see countries that go into some technical recessions.
So here's the problem for a lot of people who are seeing a gloomier side of things. Snap came out this morning, the CEO last night actually, and said that the macroeconomic backdrop is deteriorating much faster than they had previously expected. This is similar to other things that we have seen out there, basically a surprise in the negativity. Does that draw your concern, particularly with the slowdown in China and how much that's bleeding over?
We certainly are getting news that, shows more weakening in the global economy. I think one big data point is what came out of China in April. For the April numbers in terms of retail sales, that was significantly worse than we were expecting it to be. We're seeing interest rates going up in all the major economies, and it's changing quite rapidly about how much of an interest rate hike will happen and how quickly. So there are significant downside risks over here. And we have, by the way, always been flagging the fact that there would likely be stock market corrections, volatility in markets, and we're seeing that.
Are you counting on the Fed to pause in September with their rate hikes in order to achieve a more optimistic scenario?
Inflation in the U.S. is broad-based, so this is not all a supply story. There's an important demand component to it. I think it's very important for the Fed to rein in inflation as soon as possible. And even at the rates at which it's targeting right now, for some time, we're going to be in low real interest rate territories and negative real interest rates in many cases. So that's still, accommodative for the economy. So I do think they should not take the eye off the ball in terms of bringing in down inflation.
I need to link in the IMF's work, and I think people are surprised as they associate a food crisis with the World Bank or with the United Nations. And yet the IMF does prodigious work on this as well. Our Eric Martin makes clear he is studying Egypt, is, if you will, one of the test tubes of this horrific price change we're in terms of rice, in terms of wheat and such. India's led the way with the first fears of blockage of exports. What is the IMF doing to give confidence to nations that are struggling with wheat and, heaven forbid, I would say, rice?
Tom, this is a major concern for us. I mean, it's not just India, but if you look at food exports, since the start of the war, around 20 countries have put restrictions on food exports. It's be it wheat or be it palm oil and many other such products. And fertilizers also are in serious shortage. So we worry a lot about what's going to happen with food prices. I think it's one of those prices where there's probably more that's going to go up in the future than what we've already seen. And it is a major concern.
The history here is a domestic government will come to the rescue, flatten prices like the cost of bread in Egypt has been flat for decades, and subsidize whatever the commodity is until it breaks. How close in your study, country to country, are we to a breaking point of that domestic subsidy to feed people?
Look, after 2 years of the pandemic, governments around the world, especially in countries like Egypt, do not have the fiscal space to provide widespread support. And this is something that we are tracking very closely, exactly this question of how many countries are now facing these rapid increase in import prices and therefore are likely to have balance of payments problems. This is one of the trackers that we have. And this is a major concern.
How much is this a failing, frankly, of the developed world from supporting Ukraine more? In other words, from actually providing more financial aid in order to get some of those supplies to the rest of the world?
You know, this is a very challenging issue about how to get Ukraine's supply out of Ukraine. The problem is the embargo on the Black Sea. I mean, you just cannot get the ships to take the wheat out. Thinking of creative solutions in terms of putting them on trains and sending them out through that way, but that's going to take a lot more time. In addition to the war, we're also seeing the effects of climate change around the world, and one of the reasons why India has put its export restrictions on wheat is because of poor yields and bad weather. So that's another big negative. But we really do need to try very hard at this point to try and get supply up as much as possible around the world.
Given all of these pressures, how long will it be until we get inflation back to a level that is familiar pre-pandemic?
It varies depending upon the part of the world you're speaking about. But for instance, if you talk about the US, our projections in April had inflation staying above 2% well into 2024. This is core PCE inflation. So it is coming down with all the interest rate increases that are projected. Inflation is expected to decline. But I think the bigger headline is the fact that it remains well above the target for quite a while.
I want to get out front of this wonderful panel I'm doing tomorrow with you. Mariana Mazzucato will join us as well, among other worthies. Growth economics is taken for granted until you take a course in growth economics and you realize what Robert Solow did in 1957 borders on religion. We take for granted growth. My experience is the IMF does not. What do we need to do to sustain growth given 3 once-in-a-lifetime events? Global financial crisis, medical pandemic, and now a war in Ukraine. You don't take it for granted. How do we sustain growth?
I think a fact that not many people are aware of is that post the pandemic, while we have advanced economies pretty much returning to pre-pandemic trend, which is where they would have been in the absence of the pandemic, that was a projection which is likely to happen in 2023, 24. We have many emerging and developing economies that have large amounts of scarring. So for that income group, they have GDP, which is about 5% below what they would have had in the absence of the pandemic. And this divergence is something that we pay very close attention to. Of course, they had much less fiscal wherewithal to provide the kind of support that was provided in the advanced world. Vaccinations came very late to them, and they still are not vaccinated. There's now also a major demand problem over there. So all of these areas need to be fixed.
So what does a 3% GDP growth in China mean for global growth?
You know, that would be a very dramatic slowing down.
That's UBS's projection at this point.
Yes, I've seen numbers like that come out. We had 4.4% in April for China's growth, but the most recent numbers that came out, certainly there is a likelihood of a downgrade.
Does that mean global recession?
3% would reduce, obviously, the global growth from 3.6% down. It's about 20%, I would say, or around 16% to show in terms of the weightage. A lot depends upon the U.S. economy and how growth there stays. And we have growth projected at around 3.3% for the U.S. economy, which is, again, a very healthy number compared to normal years for the U.S.
Well, we have to leave. You've been very successful. The fog is lifted, and the sun has come out here in Davos with your time today. Thank you so much.
The goats are bleeding.
Thank you. We have surveillance goats on the mountainside. We'll show them to you later. Geeta Gopinath with us of the International Monetary Fund. Please stay with us. Exceptional guests this morning, including the former Prime Minister of Ireland.
story here that the CEO came out and said that the backdrop, the macroeconomic backdrop, is deteriorating much faster than he previously expected. And this echoes what we're hearing from other executives. How much does this really speak to a slowdown that has not perhaps been picked up by some of the trailing economic data?
Why did you bring in Matt Bloxham?
Well, that's really the question. Matt Bloxham, analyst for Bloomberg Intelligence, joining us now. We are seeing shares of all social media companies drop by about $100 billion in market value. Matt, at what point is this a bigger story?
Well, I mean, I think it is a bigger story. That's perhaps just